joining us is Nicole Wong. She's Regional Head of Property Research at CLSA. Nicole, thanks for joining us. Well, what did you make of the numbers on Saturday? Because it does seem as though these house price declines are being managed to some extent.
Well, yes, we think that this price decline is actually good because this is, what the government has been trying very hard to achieve. A price stabilization actually will mean that prices would have to come off, in some cities. So we are seeing it, and they are achieving the target, which means that there's room actually to start normalizing.
Would you say it's normalizing at the moment? I mean, we're seeing stability creep in there at the moment, but how sustainable is it? Because it seems like it's a very fine juggling act.
I think stabilization would come eventually. We think probably in a quarter or two, but the trend is right because the credit policy is turning around, the housing policy is normalizing, and we think that right now there is a lot of inventory, but as the purchasing power of the home buyers are very strong, so they just need a little bit of encouragement, which we are getting.
Well, there's a lot that the government could do if we actually saw some steep declines. They could easily, cut all the regulations that they put on people to stop house prices spiraling out of control.
Mm-hmm. Well, that's true, but I think this time around they want to do a little bit more of a fine-tuning rather than a very sharp movement like in 2009. So this is what we are getting. And every incremental data point suggests that we are on the path of normalization.
What about, first-tier cities versus the second and third-tier cities? We're seeing different declines for those particular categories.
I think the price decline in the first-tier cities because the margin in those cities are actually quite fat. So there's a lot of room actually to cut. Whereas in the second and third-tier cities, there are a lot of volume. So the margins have always been narrower, and there's less room for the developers to cut before they end up with actually no free cash flow.
What about the property developers themselves now? How are they dealing with this?
Everyone is focused on volume, getting the cash back. Be prepared because land prices are coming off. So if you're a developer with the cash, get it back and reinvest.
Are you seeing any evidence of these developers actually pulling out of projects, though?
We are actually seeing smaller players exiting the market. For example, there's this statistic coming out of Beijing saying that about 500 developers haven't renewed their registration in the new year. So these are players who are exiting, and we're definitely seeing more room for those developers who will persist.
Okay, what about the property companies? Let's take the ones which are registered here in Hong Kong listed. Which are the, is this all factored into their share price?
No, we think that is still far from being well factored into the share prices. We are still seeing a lot of abnormal multiples, 3, 4, 5, 6, 7 times PE, for example, is reflecting the fact that people are not confident with the earnings outlook. So we think, that will normalize as well. We'll see multiple re-rating.
Okay, so which are the companies that you like, the ones that you don't particularly?
We have always liked Coley, CL, and we are moving on to add more beta. So we also like KWG, we like AGILE, we like Vanke.
Right, thank you very much indeed for that. Nicole Wong there from our CLSA.